Welcome to this deep dive into your sources. We've received some thoughts from you about the recent turmoil in the financial markets following the announcement of new tariffs. Our goal today is clear: to dissect this situation for you, understand what's really happening, and crucially, give you the tools to navigate this period without giving in to panic.
That's right. And to do that, we'll mainly be drawing on a text you shared with us titled Panic Hits the Markets, Opportunity or Trap.
And this text highlights a major trigger: Donald Trump's surprise announcement of 10% tariffs on all imports, a decision he actually called Liberation Day.
Yeah, quite a name for it. And the immediate consequence, very visible for everyone, was this sharp market drop, the biggest we've seen since, 2020?
Exactly. Billions of dollars just vanished in a single day. It's a shock, and, it's totally normal for that to raise questions.
Absolutely. And it's precisely in this context that the old stock market saying comes up, buy when there's blood in the streets. A dramatic phrase, sure, but one that required really careful analysis in this specific situation.
Right. Caution is key here. The text you sent warns against jumping in too quickly. So why the caution when some might see a clear buying opportunity?
Well, because unlike some market corrections that you might anticipate, or ones tied to known economic factors already baked into investor expectations, these tariffs kind of blindsided everyone. They weren't predicted, so they weren't factored into how companies were valued by the market.
Okay, so if these extra tariff costs aren't absorbed somewhere else, who ultimately pays?
Well, directly, it's the companies. These tariffs hit their profit margins. I mean, imagine a company importing raw materials. If suddenly they have to pay 10% more, that automatically reduces their profitability.
And lower profits logically mean lower stock prices, right?
Pretty much. It's a fairly straightforward financial math, not just, an emotional investor reaction.
Which brings us, as the text describes really well, to the two typical reactions in a crisis. You've got those who panic and sell, and then those who actually see potential investment opportunities in the chaos.
That's it. Faced with a shock like this, you always see those two types of behavior. The first, very instinctive, is trying to limit losses by ditching assets.
The gut reaction.
Exactly. The second, which requires more thought and strategy, is asking whether this drop is justified by a fundamental change in the companies or if it's a chance to buy solid companies at a better price.
And the text really hammers home that markets, in the long run, reward strategy and discipline, not emotion and haste. So if you listening now are thinking about potentially capitalizing on this while others are pulling back, how should you approach that strategically?
Well, the first thing to consider is the nature of this crash. The source text points out something crucial. It's not based on a fundamental deterioration in the quality of solid companies. Take giants like Apple and Microsoft mentioned as examples. They're still performing well, generating significant cash flow.
Their business models haven't fundamentally changed overnight.
Right. So if the companies themselves are still solid, what explains this sudden, sharp drop? What's really changed is market psychology. The unexpected tariff announcement created this climate of uncertainty and fear. And fear, as you know, spreads incredibly fast, leading to massive sell-offs, often driven by emotion rather than rational analysis.
It's kind of like a scary newspaper headline having more impact on the market than the underlying economic reality of the companies themselves. Is that a fair comparison?
That's an excellent analogy. The text warns against that common mistake. Confusing a news item, the tariff announcement, in this case, with a tangible, immediate change in company performance. These tariffs aren't even applied yet. Their effects aren't actually measurable in concrete terms right now.
Right. And speaking of the potential strategy behind this shock announcement, Trump talks about gaining great negotiating power from these taxes. What's your read on this risky poker game?
What Trump seems to be aiming for is a form of pressure, maybe even leverage, on the U.S.'s trading partners. The goal might be to force concessions on other aspects of trade relations.
But what's the major risk with that kind of, potentially very aggressive tactic?
The main risk is that other countries just refuse to give in to the pressure. In that scenario, the situation could escalate into a full-blown trade war, with retaliatory tariffs flying back and forth.
And the consequences of a trade war like that would be far more severe than just a 10% market dip, wouldn't they?
Absolutely. A trade war would mean lower exports for everyone involved, collapsing margins for companies facing higher costs and reduced demand, a general slowdown in global economic growth, and, inevitably, a stock market decline that could be much, much worse than 10%.
So right now, the market's kind of holding its breath, waiting to see if Trump is bluffing or if he's really prepared to go through with this confrontation. And for those who did panic and sell, What are the implications of the two possible scenarios?
Well, if Trump is bluffing and trade tensions ease quickly, those who sold might miss out on a potentially significant market rebound. On the other hand, if a real trade war takes hold, their decision to sell might look justified in hindsight, but their initial losses could seem small compared to what might follow.
So either way, the text stresses the importance of being strategically positioned before the situation plays out.
Exactly. Which brings us to the crucial question for listeners. What strategy should you adopt in the face of this uncertainty? And the source is very clear on one point. Don't give in to fear.
Yeah, that's a fundamental lesson market history teaches us again and again, isn't it?
It really is. Panic selling is an emotional reaction that often leads to significant losses and, importantly, missing out on major recovery phases. We saw it in 2008. We saw it in March 2020. The S&P 500's spectacular recovery afterwards is a stark reminder.
So discipline is the key here.
Precisely. The market rewards discipline and a long-term view. If you've invested in solid companies with good fundamentals, why panic and sell based on a tariff announcement whose long-term impact is still totally unknown?
And the essential question to ask yourself, as the text highlights, is whether the fundamentals of the companies you hold have actually changed. If the answer is no, selling probably isn't the right move.
On the contrary, this period of volatility could even be an opportune moment to strengthen your positions, to acquire quality stocks at a potentially more attractive price.
Okay, so how can people actually take advantage of this volatility without trying to predict the future, which is, let's face it, practically impossible?
The text suggests a simple and effective strategy: systematic investing, or what's known as dollar cost averaging. The principle is to invest fixed amounts at regular intervals, say every month, rather than trying to time the market, buy at the absolute bottom.
Do you have a concrete example to show how effective that can be?
Sure. The text mentions investing, say, $500 a month into an ETF like VOO, which tracks the S&P 500 index, starting back in 2008. Despite all the crises and market swings over that long period, that strategy would have built significant wealth without needing to worry about the perfect time to invest. An ETF, just to clarify, is an exchange-traded fund that holds a basket of stocks.
So for savvy investors, volatility isn't seen as a danger, but more like a potential source of opportunity.
That's exactly it. When markets go down, it means you can buy quality assets at a lower price. That's the investment philosophy of people like Warren Buffett. He prefers buying good, undervalued companies rather than reacting to short-term market jitters.
And practically speaking, what should listeners do right now facing this situation? The text outlines two possible future scenarios.
Yeah, the first scenario is that these tariff tensions persist. In that case, stocks might continue to fall, potentially becoming even more attractive for long-term investors.
Okay.
The second scenario is an easing of these tensions, maybe through a trade agreement or a shift in Trump's stance. In that case, we could see a significant market rebound.
Yeah, and the conclusion seems to be that in either case, a strategic approach and a long-term view are most likely to pay off.
Exactly. Those who stay invested and continue to accumulate positions in quality companies are well positioned to benefit from the recovery whenever and however it happens. The text even mentions examples like VOO, QQQ, Apple, Nvidia, Palantir names, often among the first to recover after a correction.
So the idea isn't necessarily about making a quick, spectacular gain, but rather building wealth gradually over the long term, taking advantage of these volatile periods.
Precisely. Volatility is opportunity in disguise. Impatient, emotional investors tend to sell at the bottom, effectively transferring their assets to those with the patience and discipline to see beyond the short-term fluctuations.
All right, just to summarize the key points for everyone listening, the trigger event was this surprise tariff announcement that sent shockwaves through the markets. Faced with this, the dilemma is clear: panic or opportunity.
And it's crucial to distinguish emotional reactions, which push people to sell hastily, from fundamental analysis, which involves assessing the underlying strength of the companies. Trump's decision looks like a risky tactical move, and the outcome is still very uncertain.
And that market wisdom reminds us it's rarely wise to sell out of fear. Instead, systematic investing, like dollar cost averaging, is a proven method to navigate volatility and build capital over the long term.
So, the bottom line is, this period of uncertainty and volatility potentially offers real opportunities for those who keep calm, remain strategic, and don't give in to panic.
Okay, to wrap up this deep dive, a final thought for you. Faced with this liberation day that shook the markets, what will your own decision day look like? Will you choose an impulsive reaction or thoughtful analysis to potentially liberate long-term value in your investments? And thinking longer term, how might this kind of market shock, initiated by a political decision rather than a traditional economic factor, influence your future investment approach beyond the classic strategies we've discussed? That's something worth mulling over. Thanks for joining us on this deep dive.